Hey everybody, it's Trevor at Heritage Reverse Mortgage. This is your August home and market update. Just wanted to give everybody a quick update on what's happening in the mortgage world, interest rates and all of those kinds of things and how they're affecting us. I know a lot of you are watching the market right now. You're wanting to refinance to improve your interest rate and take advantage of the high appreciation that we've experienced over the past few years. The good news is that home values are holding very steady. And this is happening because the demand for home ownership is very, very high. You know, when we talk about recession and slowing economies, a lot of people fear that their home's value is going to suffer from that. But historically, if you've watched some of my videos before, you know that the recessions are actually a good thing for home values. And the reason for that is because recessions almost always bring, well, they always have brought, historically, lower interest rates. And when we have lower interest rates, this encourages home ownership, and this encourages home purchasing, and that boosts values. Now, most of us adults are still, feeling the PTSD of 2008 when the recession created a major crash in home values, and it took, many years for us to recover. But the good news is that historically this is not the norm. Most recessions, as I mentioned, will boost your home's value, and that's actually, we're seeing the precursors of that right now. Home values are holding steady because homeowners, because people need to buy homes, they need to upgrade their homes, or they need to relocate. And so this is really holding our home values very steady. But the one thing that continues to hold us back is interest rates. Interest rates are still much higher than we want them to be. And this is surprising to us in the industry because we've been watching the market very closely this year, obviously, because it affects us so much. And historically, we know that interest rates will follow inflation, and that is what we've seen since forever. But oddly enough, as inflation has really started to fall off this year, May, June, July, and again now in August, we've had really good inflation readings showing that inflation is coming down. There are some signs in the economy that the economy is slowing, and there's not really unemployment, but there is underemployment, meaning that instead of letting employees go, employees are just reducing people's hours. And so people are still working. They still have jobs. They're just working, 25% less than they were a year ago. And so real wages are coming down, and this affects the economy. So all of this having been said, what's going on with interest rates? This is a really weird situation. If you remember earlier this year in the spring, there was a lot of hype in the news about bank failures. Silicon Valley Bank failed, and a couple of others failed, and this was creating a massive a bank crisis that they were afraid would create a contagion that would be widespread across many banks. Luckily, the Fed and the Treasury got involved. They shored up the banks, or so it seems. Now, the reality is that they may have smoothed things over on the surface, but underneath there is still an issue here that has not been resolved. And that issue is that banks made large investments into the Fed funds rate. And with the Fed funds rate going up, all of those investments that they were making 2 or 3 years ago are now losing them money. And this is creating a liquidity issue. Likewise, people are scared, and so they're pulling money out of the banks. And so this is creating a crisis. Now, as I mentioned, under the surface, things are not as good as they look on top. And so the way banks are dealing with this is that they have to liquidate some of their assets. And some of the easiest things for them to liquidate would be their investments in treasuries, US bonds, mortgage bonds, and those kinds of things. And that is exactly what's hurting us. And so even though the inflation and other elements of the market are acting normally, interest rates are not reacting the way they should, because what's happening is banks are dumping their investments back into the market. And as they dump more of their investments back into the market, that is propping, that's affecting those mortgage bonds and those US Treasuries, and that's what's propping those things higher than they should be. So the reality is that this is a situation that cannot continue forever. We're going to have to see an end to this at some point, and so we just continue to watch and be ready for that. My own prediction, and I apologize, I've made a few predictions this year, and so far I'm not doing so good. But from what we see again historically, anytime that there's a hiccup in the market, whether it's minor or major, something as big as the Great Depression, the 1980s, 2008, or the smaller things like the recessions of the early 2000s, and etc. Typically, those market hiccups will happen towards the third and fourth quarter of the year. And so historically speaking, October is usually the month where the market really comes apart. And so that's what I've got my eyes on this year is we're watching October, watching November. If the economy and the signs of weakness that the economy is showing really start to come to a head, it will likely happen at the beginning of fourth quarter. And a slowing economy will equate lower interest rates in the short term. And so if you're in need of a refinance, if you're in need of an improvement on your mortgage to pull cash out or to improve your interest rate, stay tuned. We'll keep you posted as this starts to happen. But hopefully sooner than later you'll be hearing from us on good news that we can do something to help you live better in this crazy world of inflation and political and economic instability right now. So anyway, let us know if you need anything else, and we'll be in touch. Thanks.